Good morning, all the participants. It's immense pleasure to conduct a webinar on demystifying financial statements from our college, Badruka College of Commerce and Arts. I would like to invite Mr. Janakiram Sir, Vice Principal, to address the participants.
Yeah. Good afternoon, one and all. Esteemed resource person of today's webinar, Dr. K.V. Ramesh, Assistant Professor, Finance, IPE, Hyderabad, Director General of Badruka College of Commerce and Arts, Professor Abhiram Krishna, Principal, Dr. B. Mohan Kumar, faculty members, participants, and dear students, a very good afternoon to all of you. It gives me immense pleasure to extend a very warm welcome to all of you for the national webinar on demystifying financial statements. Badruka College is a pioneer institution in the field of commerce education. Our college is NAAC accredited, established in August 1950 with a vision to serve the society and provide quality education. We have completed 7 decades of our fruitful existence and excellence in imparting commerce education. We are grateful to the speaker of the webinar for accepting our invitation, and we are highly honored by his presence. I also express my gratitude to our management for giving the acceptance and support to organize the webinar. My thanks to all the invitees, participants, faculty members, and students for finding time to be with us. I hope that the webinar will certainly be fruitful, informative, and enlightening all of us. Once again, I extend a hearty welcome to all of you. Thank you very much. Now, I request Mr. Sriram, webinar convener, to introduce today's resource person. Thank you.
Thank you, Janakiram Sir. It's my privilege to introduce my teacher, Dr. K.V. Ramesh, Assistant Professor of Finance, Coordinator, MBA PE, Institute of Public Enterprise, Hyderabad. He holds PhD in Management, MPhil in Management, MBA in Finance, MCom LLB, PGDT, Postgrad Diploma in Planning and Project Management. He is a certified accounting technician. He has more than 20 years teaching experience. He was a visiting faculty to various institutions, including Sri Satya Sai Institute of Higher Learning, Administrative Staff College of India. A guest faculty, he visited Kyungpook National University, South Korea. He published several articles in leading journals and on various topics of finance, law, taxes, and presented international papers. Awarded Best Paper Presentation Award in the CPM Regional Conference 2018, Colombo. The Sri Lanka research paper titled A Critical Analysis of NPA Management in Indian Banking Industry, a case study of select banks, received the award from Honorable Karu Jayasurya, Speaker of the Parliament of Sri Lanka. The paper titled Implications of Law of Contract, an Indian Perspective, in a journal of Kyungpook National University, Daegu, South Korea. Book published by Lambert Academic Publishing titled Performance of Housing Finance Companies, a case study of SDFC Limited. He holds professional memberships, life membership in Indian Management Association, life membership in Indian Commerce Association, Bar Council of the State of Andhra Pradesh, life membership in Red Cross Society, Telangana State Branch. He was awarded as a Best Professor in Financial Management by ET Now National Education Leadership Award 2013. His areas of specialization includes financial accounting, management accounting, financial management, direct taxes, indirect taxes, cost accounts, business laws, contract management, so on. He has conducted national training programs on public procurement and contract administration for Sri Lanka Institute of Development Administration. He has conducted management development programs for various public sector enterprises like corporate tax planning, finance for non-financial executives, contract management for power utilities, strategic management accounting, finance and tax planning for non-financial professionals, goods and service tax, public procurement, and demystified financial statements, so on. I welcome you, sir, to address the gathering and deliver the today's topic. Thank you, sir.
I thank the management of Badruka for holding a national webinar on demystifying financial statements. I thank Principal, Vice Principal, Director General, and my dear student Sriram. Demystifying financial statements topic has been selected owing to various changes in corporate law, financial accounting, and as well as reporting. The takeaways from this program would be the profit and loss statement, balance sheet, cash flow statement, and learning with integration of various provisions relating to preparation of financial statement. Before we go into the financial statements, let us all be clear with clarity the terminology when we are preparing the financial statements, namely assets which are resources acquired and they are subclassified into floating and fixed. When we say floating, we know that these are the assets which constantly change in value that are entered into with transactions. These are meant to be converted into cash at the earliest opportunity. When we come to the fixed assets, these are the assets which are acquired by the companies with no opinion or anything to be sold in the days to come. So the intention of the company is acquiring these assets to be used in the business. They are classified again into tangible, intangible, and fictitious. Tangible assets are those which can be seen by physical touch. Intangible are those assets which cannot be felt with the touch but which are having commercial value. The most important is fictitious assets. It is said to be understood as the assets which are of no value. It doesn't mean we are putting some notional values, but because of the true and fair view, because of the technical nature, we are including in the balance sheet under the asset side. When we come to the liabilities, these are the claims to the creditors against the enterprise arising out of past activities that are to be satisfied by the disbursement or utilization of corporate resources. Just as the assets are classified, so also the liabilities are classified as current, fixed, and contingent. Current liabilities are those liabilities which happen to be an obligation to be met by a company within 12 months from the reporting date. And any other liability other than current is to be understood as fixed liabilities. We may also have a contingent liability as well, which means that they arise in future depending on happening of an uncertain event. So it cannot be pursued, but on happening of an event, we call it as a contingent liability. Sometimes we will be having an opinion of doubts with regard to how an asset is classified into current asset. Similarly, current liability. To get clarity, the criteria to classify into a current asset is if any one of the thing which you happen to relate with an asset, then the asset specified shall be classified as current asset. It is expected to be realized in or is intended for sale or consumption in the company's normal operating cycle. It is held primarily for the purpose of being sold. It is expected to be realized within 12 months after the reporting date. It is cash and cash equivalents unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. So if you are given an asset at a particular point of time, and please put this litmus test as such to ascertain with accuracy this is a current asset, and if the asset is not happening to be coming under these, then it will be a fixed asset. Now we focus on the current liability criteria. It is expects to settle the liability in its normal operating cycle. It holds the liability primarily for the purpose of trading. The liability is due to be settled within 12 months after the reporting period, or it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So just how we discussed with current assets, in the same grounds, the current liability criteria is to be settled if at all there is a benefit of doubt of a liability. Before we go into the financial statements, there are certain important terms which we have to understand. Block of assets, which is given by the Income Tax Act under Section 2, subsection 11, as a group of assets falling within class of assets, being tangible and intangible, in respect to which same rate of percentage of depreciation is prescribed. So once we are discussing this definition, we have to understand that depreciation is on block of assets, which is with respect to a financial statement. Because generally we thought of understanding depreciation is on the fixed assets. But in the financial statements, depreciation is always on the block of assets. Net worth, aggregate value of paid up share capital and all reserves created out of the profits, securities premium account, and debit or credit balance of profit and loss. This is the new amendment made to the Companies Amendment Act 2017 with regard to the definition of net worth. And this is what is the base for preparing our financial statement with the help of Ind AS. Now we focus on the Ind AS. What has been said as Ind AS is, in 2000-2001, there was an intention of making the financial reforms with regard to accounting, that is IFRS. Then there was various phases in IFRS, and ultimately we are implementing IFRS through convergence of Ind AS. So initially Ind AS has been phased into 4, and the base for the phases is net worth. That is the reason we have discussed the definition of net worth initially. And it became mandatory for all those companies which are listed or unlisted from April 1st, 2016. Its net worth is greater than or equal to 500 crores. And to understand the net worth, the definition as set forth earlier in Section 2, subsection 57 of the Companies Act 2013, along with the previous 3 years figures to be taken into account. This serves the phase 1. When we come to the phase 2, it goes from April 1st, 2017. And if the net worth is greater than or equal to 250 crores, but less than 500 crores, and net worth shall be taken into consideration for a previous 4 financial years. And this phase 2 is exclusively for a listed company or a company to be yet to be listed as on 31/3/2016. Phase 3 is become mandatory to all banks and NBFCs and insurance companies from April 1st, 2018. The net worth must be more than or equal to INR 500 crores with effect from April 1st, 2018. The net worth should be calculated for the past 3 financial years. And the finally phase 4 is all NBFCs whose net worth is more than or equal to INR 250 crores but less than INR 500 crores shall have Ind AS mandatory applicable to them with effect from 1st April 2019. This makes us to be preparing our financial statements as per Ind AS because it has become mandatory. The purpose is to provide much more qualitative with financial statements, being understandability, reliability, comparability, relevance, true and fair view, and fair presentation. The term fair presentation refers to an obligation to abide by the Companies Act 2013 Schedule 3. In that format only we have to prepare. Notification of the Ministry of Corporate Affairs on 6th April 2016 that companies are required to comply with Ind AS. The format has been prescribed in Schedule 3 of the Companies Act 2013. Further, Section 133 of the Companies Act 2013 has prescribed what are those Indian accounting standards which are to be followed by the companies in the preparation of financial statements. Till now, there are 41 Ind AS and we will be learning few of the Ind AS with relevance to the financial statement preparation. Before we do, we have to understand what is all about financial statement because earlier it was thought as final accounts. Now the relevance of final accounts is no more because of the Companies Act 2013 incorporating one person company as well a company. Because it said that even if one person is doing a business, that means an individual is doing a business, he can go to the register of companies, register himself as a company. Then the register of companies will give the individual who is doing trading yesterday as a one-person company. The moment he becomes one-person company, he has to prepare the financial statement. That is the very reason final accounts has not been used from Companies Act 2013. Section 2 subsection 40 makes it very clear to understand with crystal clear clarity with no inhibitions or contrary to the meanings which has been set forth in the section. It says clearly in relation to a company includes. So there is a need to understand that financial statement is exclusively specific to a company. And there is a need to understand from all of us to have a clarity on the term company. Section 2 subsection 20 of the Companies Act 2013 has defined a company as which has got itself registered under this act or any other previous acts. And with reference to that, it includes a balance sheet, a profit and loss account, or in case of company carrying on any activity, not for profit, an income and expenditure account for the financial year, cash flow statement for the financial year, statement of changes in equity, any explanatory note attached to or forming part of any document. So this is what the financial statement includes. And our webinar is totally dedicated towards understanding in a simple way as to the preparation of financial statement. So the first and foremost is we are doing from the perspective of only company. And what is that company is with no more discussion. Section 2, subsection 20, as we have earlier said, it is applicable to all companies which has been registered under this act, that is Companies Act 2013. Or if the said company has been incorporated under any previous law, it might be Companies Act of 1860. Still, they have to prepare the following: balance sheet, a profit and loss statement, that is profit and loss account. In the explanation of this section, it has made it very clear. Wherever the profit and loss account term is used, it is to be deemed to be understood as profit and loss statement. Cash flow statement, that is Ind AS 7, statement of changes in equity, and any explanatory note. The term any explanatory note makes very good relevance as to the transparency of disclosures and to understand in detail of any company's annual report. It is very important at this time to understand the notes. It says that provided that financial statement with respect to one-person company, small company, or dormant company may not include cash flow statement. This is most important. And second point makes it very clear. It is cash flow statement becomes mandatory. So we have to be having a clarity on the term one-person company, which we already discussed, and throw some light on small company and dormant company. As we said, a one-person company is one where there is only one person, whereas a small company, as defined under section 2 subsection 85, it says that this definition is exclusively other than public company, wherein the paid up share capital of a company does not exceed 50 lakhs or such other higher amount as prescribed, but in no case it can exceed the amount which is specified under this act. And here there is to be highlighted that the Companies Amendment Act 2017 has specified with regard to the same that no case the paid up share capital of the said company can be more than 10 crores. And it further states to understand small company from the angle of the turnover not being exceeding 2 crores or such other higher amount which might be specified. With regard to this also, the Companies Amendment Act 2017 has prescribed the higher amount being not more than 100 crores. So please understand the cash flow statement as per Ind AS 7 may be optional. That's what it says, may not include. Coming to the dormant company, which has been discussed under section 455 of the Companies Act 2013, is something which is not doing any business transaction for the year. Once it is not performing any transaction during the accounting year, they can apply to the register of companies and get themselves give a status called dormant company. And accepting these three, the cash flow statement becomes part of financial statement. So if you go and see any annual report of a company, being listed company, you will find profit and loss statement, balance sheet, and cash flow statement. Now we go to the preparation of profit and loss statement. So we are having particulars, note numbers, and we are having a comparative figures for both the current year as well as the previous year. Because the preparation of financial statements is to make the qualitative aspects also reflect in the transparency of disclosure. And most of the Ind AS are all with regard to accounting treatment of various items which are to be forming part of financial statements. When we see the profit and loss statement, there are totally 18 items. These items are exhaustive. In a sense, if any company is not having the relevant item which has been stated in Schedule 3, they can omit and they need not write the item and call itself as nil or dash. If we go strictly, we are given total income and expenses. The first item is revenue from operations. All the numbers which I have highlighting are Ind AS numbers. So our financial statements are prepared in convergence of Ind AS. So we are not taking into the accounting standards as a reflection with regard to accounting procedures. To understand revenue from operations, please understand it is the main core activities of the receipts which you are receiving or turnover which you are going to receive. This is having a close link to our section 4 of the Companies Act 2013, which says the Memorandum of Association contents, wherein there is one clause called Object Clause, wherein we state the entire ambit of the activity of business operations of the respective companies, wherein we state clearly what are our core activities, that is existence for which we are happening to register, and also includes various other things which are to be taking part, and we have to do in accordance with that identify revenue from operations. Please be careful when we are doing with revenue from operations, because of the GST has become implemented by 2017. We have to exclude the amount of GST from the sales or services with regard to the slabs which has been coming with regard to our activities. The second item is other income. And if we combine these two, we get the total income. If you overview this, the new change which has happened is the distinction between revenue and income is lost. It is now to be understood with Ind AS 18, revenue or income. So with this we complete our total income. When we come to the expenses, cost of material consumed, purchases of stock in trade. So the schedule made it very clear. It is not merely purchases, but purchases of stock in trade, explaining clearly that you have to recognize within the term purchases as those goods which are purchased, which are intended to be sold ultimately after doing certain activities over it so that they can be saleable. Changes in inventories of finished goods, similarly work in progress and stock in trade. This is with Ind AS 2 with inventories accounting. The changes in inventories refers to, as per Ind AS 2, opening of the inventories, that is, it might be relating to finished goods, work in progress, stock in trade, minus closing chain inventories finished goods, work in progress, stock in trade. Here we have to be very careful. In certain cases of the companies, if we are getting opening inventories minus closing inventories as a negative, it should be the same. Please don't be of the opinion, how can a company can have negative? Once you are getting negative inventories, that means there is a negative inventory. It requires in-depth financial analysis. So therefore, please don't change because merely you are getting a negative. So change in inventories to be understood as only opening inventories minus closing inventories. Employee benefit expense. Here also, as per Ind AS 19, what it calls for you to understand is if any payments are flowing from your employer and getting into the pocket of employee, which enables him to enjoy, then they are called employee benefit expense. In a sense, there is no distinction now with regard to salary and wage. Both are to be included within the term employee benefit. And it is not only the recurring payments, but also retirement benefits which have been paid during the year to the employees will also be identified under this head. Finance costs. This is covered by Ind AS 23 under borrowing costs. These are the amounts wherein the company is going to pay either by pay of interest because it has taken a loan from bank or financial institute, or it might have raised debt instruments upon which they would be paying interest. Depreciation and amortization expenses. We have to be very careful with this because this item includes two expenses. Depreciation, another one is amortization of expenses. The term depreciation is a something, an expenditure which has been incurred with non-cash. As we know, it is a revenue expenditure. But more than that, what is calling for us to understand in the preparation of profit and loss statement is what is depreciation. The term depreciation, to understand, has been well discussed in depth under section 32 of the Income Tax Act. To calculate the amount of depreciation, we are enabled with block of assets. That is the reason we started with important terminology, block of assets. So the term depreciation is always on non-current assets and it is on block of assets. The term block of assets has defined in section 2 subsection 11, if you recap, is with regard to assets wherein same percentage rate of depreciation is prescribed. Another most important aspect of this definition to highlight us is it includes both tangible as well as intangible. As far as the present current assessment year, we are having 10 blocks. And the maximum rate of depreciation which an assessee can claim is 45%. To understand better with the block of assets concept, please understand a building. And if there is a building which is used for residential purposes, the rate of depreciation is 5% prescribed. And if the building is not for residential, perhaps it might be used for a store, then the rate of depreciation is 10%. If we are having temporary structures of building, like wooden structures which can be called as a house, then it is 40%. In a sense, the term building is classified into three: B1, B2 and B3. B1 is for residential building, B2 for other than residential, and B3 for temporary wooden structures which are called as buildings, like boat houses. Similarly with furniture and fixtures, 10%. Now we come to the plant and machinery, which is the biggest block of assets. That starts from block 5 to 8, which says that if you are having a motor car which has been used for your personal use, then the rate of depreciation is 15%. And if the same car is used for hiring, then the rate of depreciation is 30%. Computers, hardware, software linking to that will be eligible for 40% depreciation. There was a new provision which is block 9, which carried that if at all you happen to have taxis, lorries and motor cars which has been acquired by you from August 23rd, 2019, but before April 1st, 2020, then you are eligible for 45% rate of depreciation. And the block 10 is exclusively set for intangible assets. So what are intangible? Goodwill, patent, trademark are all eligible for the purpose of depreciation under block 10. This is with regard to one aspect of the expense. When we come to the amortization expenses, the term amortization is to be understood. Amount is spread over in equal amount as an incurred expense. All these provisions are covered under section 35 of the Income Tax Act. If we take an example of preliminary expenses, section 35D, which clearly specifies that 20% of the expenditure is to be spread over 5 years. Like license fees of telecom. So there are several instances of the expenses to be amortized under section 35. You take the help of the income tax provisions, or if the management has given a direction that treatment of expenditure must be made to be distributed in equal amounts over number of years. Accordingly, we'll be doing it. And any other item which is not coming in the above said 6 expenses shall be qualified to be under other expenses. And total of these, we get total expenses. So we are having total income, that is Roman 3, and we are having expenses Roman 4. Then we go with specific items which it has been happened. Profit and loss before exceptional items and tax. In a sense, if at all during the year you had to happen an exceptional item, then there is a need to understand you have to give its impact financially to the company, whether it is by way of a profit or by way of a loss. Then state the exceptional item. Here we must highlight what is an exceptional item. It is simple that an item which is not regular is to be understood as exceptional item. And you have to go with the trade with which you are doing in the business. Accordingly, the item should be selected and determined with due recognition by the management decision. Then we get profit or loss before tax. Then we are having eighth item, very important, tax expense. That means we are calculating the amount of tax as per the Income Tax Act, relevant assessment year, and there is a need to clarify if there is an instance for your company deferred tax. The term deferred tax is to be understood as a difference in the amount of tax arising because of difference of implementation or treatment of an expense. For example, to make it much more understandable, we might be following mercantile system of bookkeeping, and we may have created as bonus payable during the year, because when you are maintaining mercantile, you take into consideration into accounting bonus payable. But if you go to the income tax provision section 43 capital B, it has made it very clear that even though you are maintaining mercantile system of bookkeeping, the following amounts are allowable as deduction only on payment basis. So one such example is bonus. Bonus, commission, employer's contribution to recognized provident fund. These are all the things. Unless you paid, you cannot claim as deduction. But if at all, because you are of the opinion, you are of mercantile system, and you have taken it as an item of expenditure, then definitely there will be a difference in tax. Similarly, other common thing is section 40 capital A clause 3, which clearly says that if at all you have made payments exceeding rupees 10,000 otherwise by DD or check, they are to be disallowed under the Income Tax Act. But if at all the accountant is not aware of this provision, or by inadvertence a cash has been paid in aggregate during a year to a client or to a supplier, say 30,000 rupees, he might be booking as an expenditure. But when it comes to the Income Tax Act, it may, as with 40 subsection A subclause 3, because the payment has been made in cash in excess of 10,000, the amount will be disallowed. So therefore, there happens to be a difference in tax amount. This is what we call it as deferred tax. Profit and loss for the period from continuing operations. Here also there should be a little bit of understanding why under the schedule 3 the continuing operations and discontinuing operations has been included. Please understand that there is a need mandatorily to specify and disclose separately as continuing operation and discontinuing operations. If you take section 3 of the Income Tax Act, which discusses with previous year, and to understand previous year, it is the year in which you have earned income, and understandably it shall be paying the tax in the next year, that is called assessment year. But please understand there are certain exceptions which has been set forth in section 3, more specifically with discontinued operations, that is discontinued business. Section 176, it makes it very clear that if the company has discontinued any of the business operations during the year, then at the discretion of the assessing officer, They might be paying the tax in the next year as normal, or they might be paying in the same year. This is what most important aspect with regard to our disclosure. So here we are in line with the disclosures and stating very clearly continuing operations and profit and loss from discontinuing operation, so that every stakeholder knows the fact that during the year there are certain operations which has been discontinued, which are reported, and if you got some profit, you have to pay the tax. That is what 11th item makes it very clear. Tax expense of discontinuing operations. And ultimately, profit or loss from discontinuing operations after tax. The moment we are calling it as after tax, please understand we have already paid tax. So that is what we have to keep it in mind when we are understanding discontinuing operations. Unless we are not linking with section 3, we might be understanding as a terminology which is not proper. Then we come the profit or loss for the period. The 14th item is other comprehensive income. So we might be having a thought. We have already completed the total income wherein we included revenue from operations and other income. Then why this head is again coming? Please understand, those are all the financial outcomes with regard to the financial performance with profitability. Now what we want to disclose to our stakeholders is to enable them to be aware of things which may happen but which has not happened with realization of income. So that's what we clarify them as other comprehensive income. And we make it very clear, items that will not be reclassified to profit or loss. So please, for good, don't be of the opinion at next year they might be included within the profit and loss. Never. Income tax related to items that will not be reclassified, items that will be reclassified to the profit or loss, income tax relating to the items that will be reclassified to profit or loss. To make it much more understandable of this other comprehensive income, as we already understood that it is not relating to the financial performance of the company, but a disclosure to enable the stakeholders to take best possible judgments. So if a company is having a plant and machinery, say 30 lakhs, and during the year they have revalued the plant and machinery, and to that extent they have revalued at 40 lakhs. The difference of 10 lakhs is the amount which will be showing as a gain on revaluation. The same amount will be shown in the balance sheet under other equity as revaluation reserves. So this is how the various items should be judged under other comprehensive income. Then we have a total comprehensive income for the period, and we are coming to a conclusion of preparation of profit and loss statement with earnings per equity share. Here also we are classifying them as for continuing operations, for discontinued operation, and finally together with the discontinued and continued. And we will be following the Ind AS 33. So with this we complete the profit and loss statement. Any doubts till now? when we are calculating EPS, we have to be very careful that we have to be abiding with Ind AS 33, wherein we calculate basic as well as diluted. The question sometimes arises is, if a company has got negative earnings, is it required EPS is to be calculated because earnings are negative? Ind AS 33 makes it very clear that it has to be calculated the impact, whether it is positive or negative. Coming to the balance sheet, here, please be clear with the numbers through which we are categorizing them. Schedule 3 has made the balance sheet into 4, namely assets and equity and liabilities. When we go to the assets, that is non-current assets. So there is no term called fixed assets. So there is only term called non-current assets. Property, plant and equipment as per Ind AS 16. So what are the things to be included within the term property, within the term plant and equipment as well discussed under Ind AS 16, and accordingly we have to identify the non-current assets of the corporate. Capital work in progress, investment property as per Ind AS 40. We should not get confused with Ind AS 16 and Ind AS 40, because Ind AS 16, though it includes property, plant and equipment, Ind AS 40 exclusively says investment property. What it wants you to understand is, when we say property, plant and equipment, these are the things which are used in the business. When we say investment property, these are the properties which has been acquired by the company, not to use in the business, but for letting out. So whatever those properties which has been acquired by the corporate or by the company, wherein they have let out, those properties are to be exclusively shown separately in accordance with Ind AS 40. Goodwill, Ind AS 38. Here we have to understand the concept of goodwill. Please understand, goodwill is the reputation with regard to the product or services rendered by a company over long-standing existence in the business or trade. If you go to the section 2 subsection 11 of the block of assets, where we have said even depreciation is on intangible assets, then the question is how we can charge a depreciation on goodwill. It has been well said, clarified, that when we are talking about goodwill, we are talking about the company's goodwill. In a sense, when a company is purchasing other company, and where the purchase consideration includes, apart from valuation of assets and liabilities, also goodwill, and wherein you acquired that business, that is the amount of goodwill on which we charge depreciation at the rate of 25% as set out under section 2 subsection 11 of the Income Tax Act. Any other tangible assets you have to specify. Intangible assets under developments, that is in due course of development. Biological assets other than bearer plants. Financial assets, wherein is subclassified into including investments, trade receivables, others to be specified, deferred tax asset. We are under non-current assets, and we are finding under the financial assets investments. You have to understand the term investments here. These are long-term investments which are not to be intended to be sold. Similarly, trade receivables, which is an attribute of trade creditors and trade debtors and bills receivable. If they are long term, that means you are not able to realize within 12 months, then we will be putting them into non-current assets. If any others are there to be specified, then we come to the item called deferred tax asset. The term deferred tax asset is coming from the term deferred tax, as we have discussed when we are preparing the profit and loss statement. But what we understand by deferred tax asset? So with the literature of deferred tax, there might be happening a difference between the book profit and the taxable profit which you have calculated. The difference between these is to be understood with regard to the concept of deferred tax asset. And when can you say the tax being deferred asset? That means it refers to the book profit, whatever you have calculated, is less than the taxable profit. Then it will be deferred tax asset. Not only the meaning, it should be understood with the aspect of impact on your company. If it in a year you have reported for your company a deferred tax asset, what we have to understand is presently you are paying tax more, and in the future you will be paying tax less. So this is the impact of the deferred tax asset. If there are any long-term borrowings, that will be classified into loans and other non-current assets. Now we come to the current assets, namely inventories. These are the stocks, being finished goods, being work in progress, being raw material, which are as on balance sheet, that is 31st March, lying with the company. When we come to the financial assets, please see most of the items are reflecting as it has been specified under non-current assets, financial assets. But please understand, when we are using the financial assets and the current assets, what we understand is these are the assets which are capable of being realizable within 12 months from the reporting date. Then we have current tax assets and other current assets. So if we combine these two, so please be cautious, the number is given by numerical numbers. Whereas when we are preparing the profit and loss statement, Roman numbers are given in the schedule 3. Now we come to the other aspect of the balance sheet, that is equity and liabilities. The term equity calls that the company is having an obligation to disclose to the owners as what is the financial position of the company. So it happens to be a disclosure aspect. Therefore, the term equity is not coming with a numbering. When we see the numbering of the equity and liabilities, it starts only from liabilities, wherein we include equity, share capital and other equity, and put together what we call it as net worth or shareholders funds. So please understand what is equity, share capital. Every company shall have authorized capital. And what is authorized capital, which is to be stated clearly in the notes when we are preparing for equity share capital. Authorized capital is the maximum amount of capital which the company perceives it needs in the life of the company. This is the amount which is disclosed under the capital clause or the memorandum of association under section 4. This is the amount which we disclose under authorized capital. Then when the company is coming for the public issue, then we use the term issued and subscribed capital. And all others, that is belonging to equity, that is reserves, are put in other equity. Then only we write liabilities. The term liabilities are again subclassified into two, that is numerical numbers. One is non-current liabilities, that is financial liabilities, borrowings, trade payables, other financial liabilities. So these are the things which are for long term, that is obligation to pay beyond 12 months from the reporting date. So if that is the case, we will be showing the same under non-current liabilities. The term trade payables includes trade creditors and bills payable. Provisions. Now we come to the deferred tax liabilities. When we are with the assets, we had deferred tax asset. Then if at all there is an instance for a company called deferred tax liability, that is when we say deferred tax asset, what we have understood is your book profit is less than your taxable profit. So to understand deferred tax liability, please understand if your book profit is higher than the taxable profit, then what we have to refer to is deferred tax liability. The impact also need to be understood here only. Presently, you might be paying less tax, but in future, you will be paying more tax. And if there are any other current liabilities, you are going to include here. When we come to the number 2, current liabilities, that is financial liabilities, if these liabilities, namely borrowings, trade payable, other financial liabilities, and other things, which are to be committed by the company to obliged to pay within 12 months from the reporting date, they are to be disclosed under current liability. And it includes provisions and current tax liabilities as well. So this is all about the financial statement of a company. So any doubts, we can clarify them. Yes. Now we come to the most important with a little bit of provisions. Because of the COVID, the banking industry and several companies are providing VRS. If the VRS is to be paid within the same year, it shall be qualified under the employee benefit expenses. However, if there is an event to happen in the next year, then they will be calling itself to be qualified under non-current liability provisions with retirement benefits. When we come to the last aspect of our financial statement, that is cash flow statement. It is a statement which describes the inflows and outflows of cash and cash equivalents during a specified period of time. The statement summarizes the causes of changes in cash position of a business enterprise between two balance sheet dates. According to the Ind AS 7, an enterprise should prepare a cash flow statement and present it for each period for which financial statements are prepared. So this is the most important aspect of our financial statements, because in cash flow statements, what we highlight is only the flow of cash and cash equivalents. The term flow to be referred is inflow and cash flow. And it goes along with your profit and loss statement, balance sheet, even though if your company has not done any business, still along with your profit and loss statement and balance sheet, the cash flow statement should also be enclosed, wherein you will be stating against each of the item nil. But no company can avoid including in the financial statement cash flow statement simply by the reason they have not done any business. So Ind AS 7 makes it very clear as to the global reporting that the cash flow statement takes into ambit of all the flows to a business transactions of any corporate, and namely they are with relation to the financial statement prepared for the period. And for the period for which you are preparing the profit and loss statement and the balance sheet, with regard to the same period, we are going to disclose the cash flow statement as well. It has been defined by the ICAA Institute as a statement setting out the flow of cash under distinct heads of sources of funds and their utilization to determine the requirements of cash during the given period and to prepare for its adequate provision. Because at no time a company can be deficient of cash. They have to provide, they have to find out the resources. A company can be at loss, but it might be book loss, but cannot be and should not be cash loss. So preparation of cash flow statement makes every stakeholder to understand its financial strength to meet the obligations by making the payments in the current year. And this is the litmus test of the financial soundness of any company. It provides relevant information about cash receipts and cash payments during a period. So what are those cash receipts? What are those cash payments which are to be coming out of a business transaction should be given with complete information. The information is useful in assessing its liquidity, financial flexibility, profitability, and risk. This is the highlight of preparation of cash flow statement, because it enables, leave alone the stakeholders, but primarily by the company itself, the financial soundness has to meet the commitments on time, that is the liquidity. It is also to meet the challenges by the various projects which the company would have taken, where it calls for additional money to be infused, whether the company is having or not. Therefore, there needs to be understanding of financial flexibility, whether we are having sufficient cash. If we find there is not that much of sufficient cash, you must try to find out the resources. You may go with your flexibility with cost of capital, and mind you, the cost as well, either by debt instruments or going by equity. You should not compromise on profitability. It makes us to be very sensitive, not only in the drive of finding funds. We should not be hurried and take whatever the funding is provided to us in the market. We should ensure that whatever the every rupee of funding we got it is at the least cost possible in the market. So please don't compromise on the term profitability when you are with need of finance. At the same time, because avenues are available to raise funds for any company, and these days the global market is our market of raising funds, you should not be tilting towards more of risk. You can welcome risk, but you cannot take the risk wherein your company will be debt ridden. As we take many corporates today in India are struggling to run their business owing to overburden of interest payments and repayments. So this is what we have to understand by cash flow statement. And unless we don't know the purpose of the cash flow statement, it is not enough to account, because accounting is not to ascertain, to determine, but also enable the managers as well as the stakeholders to make the best decisions which are made available at the time. Now we go to the Ind AS 7. It calls for cash flows or inflows and outflows of cash and cash equivalents. It has been classified into operating activities, investing activities, and financing activities. When we are going to the operating activities, these are principal revenue producing activities of the entity and other activities that are not investing or financing activities. So it has made it very clear there is never a duplication of any activity which might be looking like, but they are to be excluded. So under the operating activity, we have to identify those revenue producing activities of the corporate which are principal revenue, that is core revenue. And we have to be very judgmental, skillfully to identify those items which might be looking like operating, but in fact investing or financing. Therefore, we have to exclude the other two. The second aspect of the activities which is to be disclosed is investing activities. The term investing activities, as a very term, it is an initiative taken by the company towards acquisition of non-current assets. That's what we use the term acquisition and disposal of long-term assets and other investments not included in cash equivalents. So these are the assets which are primarily of non-current assets. It is the amount of expenditure which you might have incurred towards acquiring these capital assets, that is capital expenditure. It not only includes acquiring of non-current assets, but also if during the year, if there is any disposal of non-current assets, its profit or loss. Profit will be initiated by positive flow and loss will be with the negative flow. As well as whenever we are buying any asset, it should be signified with the negative, and when we are selling any asset, as it adds to the cash flow of our company, we'll be putting it as positive flow to the company. The last one is financing activities. Financing activities are the activities, as it term makes it very clear, these are the initiatives which have been taken by the company during the year with relating to financing decisions. That is, change in composition of contributed equity and borrowings of the entity. In a sense, if the company has taken a decision to raise more funds by going to the public by issue of equity shares, then it will be a positive flow. Similarly, if the company has gone by debt instruments for raising of money, then it will be positive flow. But please keep it in mind, whenever there is an outflow, we have to show them under financing activities only. In a sense, if any dividend is paid to the equity shareholders, that is a negative flow. When you are coming to the borrowings, that is, we have to repay the principal borrowing once the redemption period has come or the due date for the borrowing has come. Or it might be annual future wherein the interest payments must be paid for the amounts of debentures which has been raised by the company. So these are the things which are to be shown as negative flow. So these are the various activities which are to be clearly specified when we are preparing the cash flow statement as per Ind AS 7. Now, how to prepare this is most important. Identifying the items, we are given very good clarity, but how to do it? Please understand, the cash flow statement is the reflection of truth and fair view as well as presentation of your financial statements. How? Please understand, when you are preparing the balance sheet, under the current assets, we are having cash and cash equivalents. And as you know, our finance statements are comparative. That means for both the years, we are given the figures. One is the current year is closing and the earlier year is the opening. When we prepare the cash flow statement, what is the purpose is to prove that there is only genuine payments, genuine activities, and any outflow happened, these are genuine and honest and sincere. Thereby we try to prove how the flow of cash has happened during the year because we are doing some business activity, having classified into operating, investing, and financing. So the outcome of this cash flow statement is we are proving that we arrive at closing balance of cash and cash equivalents. For example, operating activities, we got a negative out of the outcome. Investing activities, we have to take into consideration the net outcome. And financing activities, as we have taken the outcome of operating and investing, financing activities also net. The term net means operating activities plus investing activities plus financing activities. So if we are getting a positive flow out of these, we use the term by clearly specifying increase in cash and equivalents. If we are having a decrease by outcome of these activities, we are going to write decrease in cash. To that outcome, we are going to take the opening cash and cash equivalents. When we add up to the outcome of the cash flow from all activities, we would be arriving certain amount that is called closing cash and cash equivalents, and what we have derived here will be, shall be, must be the amount which is the same as you have derived under the balance sheet current assets cash and cash equivalents. This is very important because if any fraud has happened or committed, here we can easily identify wherein the fraud might took place. One note, when we are preparing the operating activities, because the term operating activities, we do recognize the outcome of working capital as well. That, as we are aware, working capital is the difference between the current assets and current liabilities. So when we are doing with operating activities, wherein we take the reported profit and we adjust all non-cash, non-operating items, for example, any reserves, goodwill written off, depreciation, then we reduce from that any profit on sale of non-current assets, so on and so forth, including the opening balance of cash. Then what we get is operating activity before working capital. In a sense, we are do take to impact specifically working capital impact as well. When we are taking the working capital as to the impact of the cash, due care should be taken not to recognize cash and cash equivalents as an item of current assets. For a simple reason, that is the very purpose for which we prepare the cash flow statement. So if it happens to be an increase in current assets, or with regard to the current liabilities decrease, which will have a negative impact, and vice versa. Only upon taking into account the impact of working capital and your cash flows only, we would be arriving at operating activities. Then we combine these, and this will be our Ind AS 7. Most important factor under Ind AS 7 is it makes us to understand if in a company, if at all, overdrafts are there, then whether to be taken into account as cash and cash equivalent or not. That is most important. And Ind AS 7 has made it very clear that it is to be recognized as when we are preparing the Ind AS 7. So there are several aspects when we prepare Ind AS 7. We have to do care. What are the attributes which are to be taken into account when we are preparing the cash flow statement? Furthermore, to highlight the cash flow statement, it has been made it very clear under Ind AS 7 when we are drawing up the financing activities. More specifically, it says that cash payments to owners to acquire or cash proceedings from mortgages are to be taken into account. Another most important attribute of Ind AS 7 is any cash payments when the company is by way of lessee for the reduction of the outstanding liability relating to a financial lease shall be taken into account as an attribute within the term financing activity. It made it very clear that the component of cash and cash equivalents shall do include if bank overdraft are repayable on demand. This we have to remember, and we have to include bank overdraft within the term cash and cash equivalent. Otherwise, we might be mistakenly recognizing it as a current liability. So this is what we have to be very careful when we are preparing Ind AS 7. And more particularly, contribution of Ind AS is, it is applicable to all. That is most important. So it never said, is it applicable to small company? Is it applicable to dormant company or small share company? Or is it applicable to a private company, government company, associate company, or a public company? So this is what we have to understand under the preparation of Ind AS 7. At any moment of time in the preparation of Ind AS 7, if the outcome of cash flows which we are arriving is not the same as we derive and reflected in the balance sheet as cash and cash equivalent closing balance, that is the balance as for the present year, please understand there happened to be fraud or a manipulation of the activity relating, so that the inquiry has to be done by the management at the right time. If the management is not showing that much of relevance to Ind AS 7, then the fraud will be perpetuated in the said company. Like we see in number of cases, the companies have been closed, and we find to be a surprise whether the company is closed because they got loss and the management says got loss. And you put a question, what is the cash flow? And they are reluctant to share the cash flow statement. And Ind AS 7 has made it very clear as mandatory. So it might be a financial distress, but at the same time, they have to disclose why it happened, because it is the internal management of the company must know critically the reasons for which that financial disaster has happened, wherein from any activity we are getting a negative flow. So these are what we have to understand with the financial statement. And please be careful when we are preparing the financial statement, we are helped out with as many note numbers as possible. In a sense, the Companies Act 2013 calls for companies to be crystal clear in disclosure, whereas transparency should be taken at the utmost care, apart from financial disclosure. That is how we find so many companies wherein your annual report is around 400, 500 pages, but your financial statement is only 3 pages. This is the very reason. So with this, I conclude the financial statements, and any doubts we'll be discussing. Thank you. Sriram, any questions? Any questions?
Cash flow statement is asking. Just give a brief. Anurag is asking a question, sir. What is cash flow statement? Please give some detailed information regarding the cash flow statements.
Yes, sir. The term cash flow statements is to be understood from the perspective of Ind AS 7. It shows in complete in nutshell what is the flow of cash. And within the term cash, please understand it is a broader aspect. That is, it includes cash and cash equivalents. The term cash equivalents refers to the company's bank balances, either in India or overseas. And when we want to understand the cash flow statement, Ind AS 7 has made it very clear that it should be categorized or classified to make it meaningful understanding out of the business transactions, namely operating activities, investing activities, and financing activities. The very purpose of cash flow statement is to prove that during the year, all the transactions have been taken into account and no transaction which has not taken place has not been recorded. Thereby, we are we will be in a position to prove that whatever the amount you arrive under Ind AS 7 cash flow statement will be the cash and cash equivalent closing balance as stated in the balance sheet. Clear, sir?
Sir. One more question from Sirisha, sir. What is the difference between amortization and impairment of assets?
The term amortization impairment of assets was referred to in accounts. But now with the Schedule 3, all these are coming within the term amortization. There is no distinction now. That's why when we are preparing the profit and loss statement, we have understood the expenses, depreciation and amortization expenses. So now there is no distinction. Clear?
Next question is explain in brief discounting operations one, sir.
Discounting operations.
Yes, sir.
Can the question be pronounced again?
So explain in brief about the discounting operations.
There is no such term called discounting operations when you are preparing the financial statement.
Right. Thank you, sir. These many questions I have received from the participants. Now
Okay,
I invite my principal, Dr. M. Mohan Kumar, sir, to address the participants.
Thank you.
Good afternoon, everyone. At the outset, I would like to thank Ramesh sir for accepting our invitation, and in spite of his busy schedule, he has got a meeting at 2 o'clock. Again, we have rescheduled the webinar. I wholeheartedly thank you for all the efforts you have done, sir. And I even thank our team members, Mr. Sriram, Naveen, and Janakiram sir, for doing all this organizing works. And to all the participants, I think you had such a wonderful learning today. It's been more than 1.5 an hour learning, which is given by Ramesh sir. I wholeheartedly thank you once again, sir, for that. Over to Sriram.
Thank you, sir. Thank you so much, Ramesh sir, for enlightening the participants regarding financial statements, accounting standards, cash flow statements, etc. I would like to invite Naveen Kumar, IQAC coordinator, to present vote of thanks.
Very good afternoon, everyone. Distinguished speaker, resource person, and proud alumni of our Bhadruka College, Dr. K.V. Ramesh sir, IPE Hyderabad. Thank you, sir. Thank you for giving your valuable time and such a wonderful, valuable information and contribution to all the participants. I thank our management for encouraging and supporting for conducting this webinar. I also thank our Director General of Bhadruka Group of Institutions, Professor Abhirama Krishna sir, for giving opportunity. I thank our principal, Dr. B. Mohan Kumar sir, for encouraging, for conducting such webinars for the students, faculty, and researchers in the present scenario. I also thank to our vice principals, Dr. M. Srinivas sir, Dr. Rajesh Agarwal sir, Srimati Anupama madam, and Janakiram sir. I also thank Mr. Sriram for selecting a good topic in the present scenario for hosting the webinar from the college side. I also thank all the faculty, participants, and students for attending the webinar. Thank you. And I would like to also thank the technical team, Hayat Basha and others, for extending their technical support for smooth conduct of the today's webinar. Once again, I thank each one of you for successful conduction of this webinar. I hope this webinar is enlightened all the members. Thank you.
Thank you so much, sir. Thank you, Ramesh sir. Thank you, principal sir. Thanks, Basha and Nalin, Janakram sir. Thank you so much.
We will feedback.
So we post feedback into the chat box now. So all the participants who fill the feedback will get e-certificates to their personal mail IDs within 7 to 10 days. So please fill the feedback. Don't exit before filling the feedback. Thank you. Thank you so much.
Yes.
Feedback.
Mute.
Yeah.